The next Great Depression did not begin with panic, sirens, or a market crash splashed across headlines. It began quietly, inside a press conference wrapped in careful language and economic confidence. While most people were watching stock prices and inflation numbers, a much deeper shift was taking place. The Federal Reserve made a series of decisions that didn't just slow the economy, they changed its trajectory. What looks like stability today is actually delayed damage. What feels like control is only time being borrowed. And history shows that when central banks start borrowing time, the bill always comes due all at once. Every major economic collapse follows the same psychological pattern. First, policymakers insist the situation is under control. Then markets calm down just enough for the public to relax. And finally, the real damage appears when no one is emotionally prepared for it. That is exactly where we are now. The Federal Reserve claims it is fighting inflation, protecting employment, and preserving financial stability at the same time. But no central bank in history has ever pulled off that balance at extreme debt levels. What the Fed is actually doing is something far more dangerous. It is tightening a system that is already structurally broken and pretending the cracks are temporary. This is not a story about a single rate hike or one bad policy meeting. This is about a system that has been artificially kept alive for more than a decade. Since 2008, the global economy has been running on cheap money, suppressed interest rates, and expanding debt. That era created the illusion of growth, but it also created dependence. Governments learned they could borrow without consequence. Corporations learned they could survive without profit. Markets learned they would always be rescued. When the Federal Reserve finally reversed course and raised rates aggressively, it didn't restore discipline. It triggered stress fractures across the entire financial structure. What makes this moment so dangerous is that the damage does not appear immediately. Rate hikes work with a delay, sometimes 12 months, sometimes longer. That means the economic pain people feel today is not coming from the most recent decisions. It's coming from decisions made a year ago, and the most destructive effects of current policy haven't even arrived yet. While headlines celebrate falling inflation or resilient markets, the foundation beneath the economy is quietly weakening. Debt is becoming more expensive. Liquidity is drying up. And institutions built on low-rate assumptions are being forced into survival mode. This is why comparing this moment to an ordinary recession completely misses the point. Recessions are short-term contractions inside a healthy system. Depressions happen when the system itself no longer functions as designed. In the 1930s, the collapse was driven by credit destruction and policy mistakes. Today, the scale is far larger, the leverage is deeper, and the global connections are tighter. The Federal Reserve is trapped between protecting the dollar, controlling inflation, and preventing a debt implosion. And every path it takes worsens one of those problems. And the most unsettling part is that nothing dramatic needs to happen for this to end badly. There doesn't need to be a crash tomorrow. There doesn't need to be mass panic. The next Great Depression, if it unfolds, will likely arrive slowly through tightening credit, silent bank stress, falling real incomes, and political instability. By the time it becomes obvious, the damage will already be locked in. The question is no longer whether the Federal Reserve made the right move. The real question is whether the system can survive the consequences of the moves already made. The Federal Reserve likes to present itself as the ultimate control room of the economy. Through interest rates, balance sheet adjustments, and carefully worded statements, it claims the ability to manage inflation, protect employment, and stabilize markets. To the public, this creates the impression that the economy is guided, calibrated, and corrected in real time. Inflation rises, rates go up, growth slows, rates come down, markets wobble, liquidity appears. This narrative suggests precision and mastery, as if the economy were a machine with dials that can be turned smoothly to keep everything running. But this belief in control is largely an illusion. Inflation is not something the Federal Reserve directly controls. It is the result of supply chains, energy costs, fiscal spending, demographics, and global shocks. Employment is not created or destroyed by interest rates alone. It depends on real demand, productivity, and business confidence. Market stability, meanwhile, is often mistaken for rising asset prices, even when those prices are being inflated by cheap money rather than real economic strength. The Fed does not shape these forces. It responds to them, usually after they have already moved. This reactive nature is the central problem. By the time inflation shows up clearly in official data, it has already been building for months or even years. By the time unemployment rises enough to trigger concern, companies have already begun cutting investment and freezing hiring. By the time markets break, confidence has already collapsed beneath the surface. The Federal Reserve is always looking in the rearview mirror, adjusting policy based on past conditions, while the real economy continues moving forward into unknown territory. The most dangerous aspect of this delayed response is something most people never hear about: policy lag. Monetary policy does not work instantly. When the Fed raises interest rates, the effects ripple slowly through mortgages, corporate loans, government debt, and consumer credit. Historically, those effects take anywhere from 12 to 24 months. to fully hit the real economy. That means today's rate decisions are shaping economic conditions 1 or 2 years in the future, not stabilizing the present. This creates a deadly timing mismatch. The Federal Reserve raises rates because inflation looks high today, even though the economy may already be slowing beneath the surface. Then, months later, as higher borrowing costs finally bite, investment collapses, layoffs accelerate, and credit tightens everywhere at once. By the time the damage becomes obvious in official data, the forces causing it are already deeply embedded. Cutting rates at that point doesn't reverse the harm, it only acknowledges it. History shows this pattern repeatedly. Central banks tighten too late, then ease too late, amplifying the cycle instead of smoothing it. The illusion of control comes from focusing on short-term market reactions rather than long-term structural effects. Markets may rally on the hope of future cuts, but businesses still face higher refinancing costs. Consumers still feel the pressure of expensive credit. Governments still carry massive interest burdens that grow heavier with time. The most unsettling truth is that when the Federal Reserve finally recognizes the full scale of the damage, it is often powerless to stop it. Once credit contracts, confidence evaporates, and balance sheets weaken, momentum takes over. Layoffs feed lower spending. Lower spending feeds more layoffs. Defaults spread. At that stage, the problem is no longer inflation or interest rates. It is systemic breakdown. And by then, the illusion of control disappears, replaced by the reality that the consequences were set in motion long before anyone was willing to admit it. For decades, the global economy has been built on one hidden assumption. Debt will always be cheap. Governments expanded spending on the belief that interest rates would remain low indefinitely. Corporations borrowed aggressively, not just to invest, but to buy back shares, roll over old liabilities, and survive on thin margins. Households were encouraged into mortgages, auto loans, credit cards, and student debt under the promise that manageable monthly payments mattered more than total cost. This created an economic structure where growth did not come from productivity, but from leverage layered on top of leverage. At the government level, debt has reached a scale never seen in peacetime. Trillions in sovereign bonds must be rolled over continuously just to keep the system functioning. When rates rise, governments don't feel the pain immediately, but as older low-interest bonds mature, they must be refinanced at much higher costs. This turns interest expense into one of the fastest-growing budget items, forcing either more borrowing, spending cuts, or money creation. None of these options restore stability, they only delay the reckoning. Corporate debt is even more fragile. Many companies survived the last decade not because they were profitable, but because they could refinance endlessly at near zero rates. These so-called zombie companies generate just enough cash to service old debt, but not enough to pay it down. Rate hikes shatter this model. As loans mature, refinancing suddenly becomes more expensive or impossible. What looks like a healthy corporate sector on paper quickly reveals itself as a collection of balance sheets held together by cheap credit. Households sit at the base of this structure, and they are hit from both directions. Higher interest rates raise the cost of mortgages, credit cards, auto loans, and personal debt, while inflation erodes real income. Even those with fixed-rate loans feel the pressure through higher rents, insurance, and living expenses. Consumption slows, not because people want to spend less, but because debt servicing consumes a growing share of income. When households pull back, the entire economy follows. The real danger emerges when all these pressures hit at once. This is where the hidden trigger lies: refinancing walls. Massive amounts of government and corporate debt are scheduled to mature within a narrow time window. When that wall is reached, borrowers must either accept sharply higher rates or default. There is no gradual adjustment. The shift is sudden, mechanical, and unforgiving. Banks sit at the center of this stress. They hold long-term bonds and loans issued at low interest rates, now worth far less in a higher rate environment. On paper, many of these losses are unrealized. In reality, they are only hidden as long as assets are not forced to be sold. When withdrawals rise or liquidity tightens, those losses become real instantly, eroding capital and confidence. This is why rate hikes are no longer a normal policy tool, they are toxic. Raising rates inside a debt-addicted system does not cool excess. It breaks the support structure entirely. The Federal Reserve did not raise rates in a healthy economy with room to absorb the shock. It raised them in a system engineered around perpetual cheap money. Once that assumption died, the system began unraveling from the inside out. Banks are often portrayed as the strongest pillars of the financial system, but in reality, they are among the most fragile institutions in the economy. Their stability depends not on strength, but on confidence. Modern banks operate on thin capital buffers, heavy leverage, and a fundamental mismatch between what they owe and what they own. When conditions are calm, this structure appears stable. When interest rates rise rapidly, its weaknesses are exposed all at once. And one of the least understood dangers inside the banking system is unrealized losses. Over the past decade, banks loaded their balance sheets with long-term government bonds and low-yield securities, assuming rates would stay low for years. When rates surged, the market value of those assets collapsed. On paper, these losses can be hidden as long as the assets are held to maturity. But economically, the damage is already done. The value has fallen, and that value only becomes real the moment the bank needs liquidity. This is where duration mismatch becomes fatal. Banks fund themselves with short-term liabilities like deposits, which can be withdrawn at any moment, while holding long-term assets that cannot be quickly sold without loss. When depositors demand their money, banks are forced to sell assets at depressed prices. What was once an unrealized loss instantly becomes a realized one, eating into capital and threatening solvency. Authorities often respond to these moments with bailouts, emergency lending facilities, and reassurances. But this is where the distinction between liquidity and solvency becomes critical. Liquidity means access to cash. Solvency means assets exceed liabilities. Bailouts can provide liquidity, but they cannot magically restore lost asset value. If a bank's assets are structurally impaired, pumping in cash only delays recognition of the problem. It does not fix it. Confidence, meanwhile, collapses far faster than balance sheets. Depositors do not wait for quarterly reports or regulatory reviews. They react to headlines, rumors, and fear. Once doubt enters the system, rational behavior changes. People stop asking whether a bank is technically solvent and start asking whether their money will still be there tomorrow. In that environment, even a healthy institution can be overwhelmed by withdrawals. This is why banking crises spread silently before they explode publicly. Stress builds beneath the surface as losses accumulate, funding costs rise, and trust erodes. By the time regulators step in, the damage is often already irreversible. Each intervention meant to calm markets also sends a hidden signal that something is wrong. The most dangerous part is that these failures rarely look dramatic at first. There is no single moment where assets go to zero. Instead, there's a gradual evaporation of belief. Customers withdraw, counterparties pull back, credit lines are cut. The institution suffocates not from insolvency alone, but from isolation. Banks don't fail when assets go to zero. They fail when trust does. And in a high-rate environment layered on top of years of excess leverage, trust becomes the most fragile asset of all. To understand the scale of what is unfolding, it is critical to separate today's crisis from the one in 2008. The global financial crisis was severe, but at its core, it was a credit accident. Excessive risk built up inside a specific part of the system, housing finance. And when that bubble burst, it triggered a chain reaction through banks and markets. The damage was enormous, but it was also contained enough for policymakers to respond with aggressive intervention. Debt levels were lower, balance sheets were cleaner, and the Federal Reserve still had credibility, flexibility, and room to act. Today's situation is fundamentally different. This is not a localized credit failure. It is a systemic breakdown driven by sovereign debt and monetary credibility. Governments themselves are now the most leveraged entities in the system. Public debt has exploded after years of stimulus, bailouts, and crisis management. Unlike households or corporations, governments cannot default easily without destabilizing their entire economies. That makes central banks the backstop of last resort, not just for banks, but for states themselves. This is where monetary credibility becomes the real battleground. The value of modern money is based on trust. Trust that central banks will protect purchasing power, trust that governments will manage debt responsibly, and trust that the system will remain stable. Once that trust erodes, everything built on it begins to weaken. Inflation is not just a rise in prices. It is a signal that confidence in money is fading. The crisis is also global in a way 2008 never fully was. The US dollar sits at the center of the international financial system. When US rates rise, global liquidity tightens. Emerging markets suffer capital outflows. Foreign governments holding US debt face losses as bond prices fall. Some are forced to sell treasuries to defend their own currencies or stabilize domestic markets. This quiet foreign bond dumping adds pressure to US borrowing costs and undermines the illusion of infinite demand for American debt. This creates a trap with no clean exit. If the Federal Reserve cuts rates to relieve pressure, it risks reigniting inflation and triggering a loss of confidence in the dollar. A weaker currency raises import prices, fuels capital flight, and accelerates the erosion of purchasing power. If the Fed holds rates high to protect credibility, it intensifies debt stress across governments, corporations, banks, and households. Defaults rise, growth stalls, political pressure explodes. Unlike 2008, there is no clear lever left to pull. Back then, cutting rates and expanding the balance sheet restored confidence because the system could still absorb it. Today, those same tools threaten the foundation of the currency itself. Every policy choice now carries systemic consequences. This is why the Federal Reserve has no winning move. It is balancing inflation against solvency, credibility against collapse. Each decision sacrifices one pillar to protect another. The longer this tension persists, the more unstable the system becomes. What once looked like a powerful institution guiding the economy now resembles an entity trapped by the consequences of its own past success, unable to reverse course without breaking something critical. A depression is not simply a deeper recession. It is a different economic condition altogether. Recessions are cyclical downturns where growth pauses, unemployment rises temporarily, and recovery follows once credit flows return. Depressions, by contrast, are periods where the mechanisms that normally restart growth no longer function. Jobs do not come back quickly. Credit does not expand. Asset values do not recover to previous levels. Instead of a short shock, the economy enters a prolonged state of stagnation and decay. One defining feature of a depression is long-term unemployment. This is not about temporary layoffs or short hiring freezes. It is about jobs that disappear and never return. Businesses close permanently. Entire sectors shrink. Skills erode as workers remain sidelined for years, not months. When unemployment becomes structural rather than cyclical, consumer demand weakens on a lasting basis, feeding back into lower investment and slower growth. Another core element is credit contraction. In a healthy economy, banks lend, businesses invest, and consumers spend. In a depression, this flow reverses. Banks become defensive, tightening standards and hoarding liquidity. Borrowers focus on survival rather than expansion. Even when interest rates are lowered, loans are not taken because confidence is gone. Credit stops being a growth engine and becomes a bottleneck. Asset destruction is the third pillar. During normal downturns, asset prices fall and then recover. In a depression, valuations reset permanently. Real estate, equities, and businesses lose value not because of panic, but because future cash flows are fundamentally weaker. Wealth evaporates, balance sheets deteriorate, and the ability to borrow against assets disappears. This locks the system into a self-reinforcing slowdown. Many assume that massive stimulus will prevent this outcome, but that assumption rests on outdated conditions. Stimulus works when debt levels are manageable and productivity gains can absorb new money. Today, the opposite is true. Debt is already overwhelming. Adding more does not stimulate growth. It diverts income toward interest payments. Productivity growth is weak, meaning new money chases existing assets rather than creating real output. The result is inflation or financial instability, not recovery. This leaves policymakers with shrinking options and growing consequences. Attempts to restart growth through spending or monetary easing risk undermining confidence in the currency and worsening inequality. Attempts to impose austerity deepen unemployment and social strain. Every path carries political consequences because economic pain eventually demands a response. The final danger is psychological. Depressions do not announce themselves with a single dramatic collapse. They unfold slowly through years of frustration, declining living standards, and institutional breakdown. Trust in markets fades. Trust in governments erodes. Political polarization intensifies as people search for someone to blame. The warning is clear. If this turns into a depression, it will not arrive overnight. It will grind forward quietly, reshaping society long before it is officially acknowledged. And by the time it is named, escaping it will be far harder than preventing it ever was. What matters most in understanding this moment is separating blame from reality. The Federal Reserve did not single-handedly create the conditions that now threaten the global economy. The system was already fragile, already over-leveraged, already dependent on cheap money and constant intervention. But what the Fed did do was remove the last illusion that this structure could unwind safely. By raising rates into extreme debt, by prioritizing short-term credibility over long-term stability, it locked the system into a narrow path where the outcome is no longer flexible. The choices ahead are not about avoiding pain. They are about deciding where the pain will land. This is why the real story is not about a future crash waiting to arrive. The mechanisms that define a depression, credit contraction, asset destruction, and structural unemployment are already in motion. They are just being managed, slowed, and disguised through policy language and emergency tools. The title, The Next Great Depression, suggests something dramatic and sudden, but that misses the deeper truth. This is not an event on the horizon. It is a process unfolding in real time, controlled just enough to prevent panic, but not enough to restore health. Every intervention now serves one purpose: delay recognition, delay defaults, delay political consequences. But delay does not mean reversal. The longer the system is stretched under pressure, the more brittle it becomes. Each attempt to stabilize creates new distortions, new imbalances, and new risks that must be managed later. What looks like control is really escalation, larger interventions to counter larger problems created by earlier ones. This is how economic eras end. Not with a single catastrophic decision, but with a series of reasonable ones that narrow the future until only hard outcomes remain. The Federal Reserve is no longer steering the economy toward growth. It is managing decline, choosing which parts weaken first and which are protected the longest. That is the defining shift of this moment. The Great Depression is not coming, it is being managed. And managed systems do not heal. They degrade slowly until something fundamental gives way. History doesn't repeat, it escalates. If you want to understand what breaks next, stay alert.